We expect the Fed to cut rates as early as March 2024 and as late as June. You might be thinking, well, if they cut rates, that's just a good thing, right? But Wall Street has different predictions. Let's take a look at whether a rate cut could be good or bad for the stock market. Let's start with the bad news. In the first half of 2024, when rates are cut, let's take a look at the two main reasons why a rate cut would be bad for the stock market. 2 reasons why the stock market could be bad at the time of a rate cut. 1. Market distrust. Market distrust. Rate cuts are often interpreted as anxiety signals about the economy. In particular, there is a concern that the central bank will only cut rates when a recession is definitely expected, and not proactively. So, right up until the day of the cut, there can be a debate about whether a recession will accompany the rate cut, or whether the rate cut will be preemptive and prevent a recession from happening in the first place. This bifurcated debate can create anxiety, which in turn can lead to fearful signals prevailing and adversely affecting equity markets. 2. Fear of a return of inflation. Fears of resurgent inflation. There are fears that a hasty rate cut could inadvertently trigger inflation that was thought to be contained. This increases uncertainty in the economy, which can negatively impact the stock market. The impact of rate cuts on the stock market needs to be approached from multiple perspectives. It should always be understood that positive and negative views coexist, riding a wall of anxiety that can drive stock prices higher or lower. The same will be true in the period immediately before or after a rate cut. There will be no one dominant view, and as always, opposing views will clash, and anxiety can be especially high before and after a big event. Next time, we'll look at why a rate cut is a good thing. If you have any questions, leave them in the comments.